In today's Nugget episode, we will talk about one of the major reasons traders are not successful. Most traders think they have to look for trades and setups in the chart. The reality is the exact opposite. We have to find the moments where you should not take a setup, not take a trade. I will show you in detail what that means. For me, there is three major areas for not taking trades, and we will go through them one by one. The first is if there is even no setup. The second is if your mindset is not okay. This is much more important than most people are aware of. And then the most tricky part and the major part of this video, if a setup is confirmed, but you shouldn't take the trade. This is really tricky and difficult, so we will focus mostly on this one. But let's start with the first. First, a recap. What is a setup? You always have to bear in mind that we are trading markets that are set up, not movement. We are not interested in movement of the market. We are interested in a setup. A setup is a distinct liquidity distribution, a distinct structure in the market. So it's building up a structure and liquidity, and we wait for the moment that unloads this liquidity. If it just moves in a direction, that's not a setup. That's nothing that has high probability. And if we have this setup, then there's a couple of other things that are necessary to make it a strong setup. As we discussed in the last episodes, we want to have other time frame traders driving. They need to be triggered into the market. We want to have a multi-time frame alignment so that the trend is pointing in the same direction, the bias is pointing in the same direction across all time frames, preferably. Then we look at timings, time rotation, timings, levels, behavior of price at the level at the right time. And then, especially as also discussed in the last nugget, we need to have traders trapped. So either we have a strong push by other time frame traders driving in a specific time frame, or we have traders trapped and they get punished. So these are the things we will look at. First area, three major reasons where there is no setup. That means the market is not set up yet. Or not anymore. So first reason, it's too early. So early in the template, front side of the move, large major events coming up like FOMC, non-farm payroll, and the market drags traders into this event and then unloads. Be very aware of that. You can take front side trades, but you need to be aware that this is not as explosive as the backside trades. So don't push it on the front side. Wait for it to set up completely. Then, very important, if the liquidity in the chart is taken out, there is nothing more to do. So right after large moves, a big impulsive move into a level, then it's 50-50. You don't know, it might do a dead cat bounce, it might continue. If it still has fuel for the move, then you might take a continuation. But mostly people are chasing these moves, and this is very dangerous. Also, for example, if you have news that swept both sides, then there is nothing to do. Then you have to wait for the market to set up again. Taking the high, taking the low, coming back in, then you just do nothing. And then, this is very often the case, of course, conflicting information. So if the time frames disagree, you have a large range and you're inside, no clear story, you might build a thesis in your head, but just don't take these low probability situations. Sit on your hands and wait for the real setups. Here an example of the last FOMC meeting, Wednesday 29th of October, Nasdaq chart. So here you see this was the FOMC meeting. It was 2 p.m. Eastern time. So you see it was building up liquidity into the FOMC meeting. So potentially you can take front side trend trades into this situation, But on the day, especially, you see there the market is waiting for the FOMC meeting. So that's the reason why you don't want to trade on days with such large news releases, especially not with the pairs that are infected strongly, like the indices on FOMC, of course. And then you see here the sweep both sides, trapping the shorts, trapping the longs, coming back in. So this whole liquidity that has been on the chart, that has been unclear anyways, is even also taken out. So then you see the next day completely different. It fakes out the high, triggers new time frame traders in the market, and then you get nice moves again on the backside of the week. The next area is the mindset. It's absolutely critical that your mindset is in the right place. Really focus on it. If you feel the urge to trade, it's all coming back to FOMO. If you have the urge to trade, you should not take any trade. How can this happen? For example, that you see large moves happening in the market. This is an absolute moment to be cautious. If you see others winning and you think you should win too, or if you stopped out of a trade and you want to make it back, you know all of that. This is all red flags to not trade, to get off the screen, go around the block and come back. The only way to be successful if you are in front of the screen and you are not looking for trades and you don't try to make money. This is absolute prerequisite to be successful. You know it. You have experienced this many times, right? Watch your inner state. If you are in this state here, I hope I can catch a trade. Damn, the other guys are killing it. This has to work. Then you know exactly what comes next. What you need to do is that you are fully prepared. You're sitting in front of the screen, maybe even leave it with the open. That's what I'm doing most of the times. Come back only to time rotations and watch the screen. And you always have the feeling in your stomach, I don't need to trade today. I really wait if the market convinces me. So you're not actively looking for a trade. And if something confirms, then your major focus in your mind is, why should I not take this trade? And only if there is no reason left, then you take it. So let's assume you didn't do any stupid things. You didn't jump into a trade that is not confirmed. You're at the right state of mind. You waited for time rotations and the setup confirms. And then the hard part comes. I'm very convinced that this is what really makes you money. If you have a system and a lot of mechanical rules, this brings you into the game. But to really make significant money, you need this here. You really need the intuition when to not trade and when to take it. This makes all the difference in the world. So let's look at it. This is my rules based on my system, of course. So red flags. So if you are in a trade and the range is too narrow, you have no space. So all your criteria might confirm, but there is significant levels ahead, and there's not enough space for the trade to run. Then you have to wait, even if everything else flashes green. Second point, switch levels disagree. That comes down to market structure. I will show you this. If the switch levels, this is what I'm looking at to define the bias across all time frames. On the lower time frames, if you have switch levels in your back, that's what you want to have. If you have the switch levels in front of you, then you have to wait until they flip. Otherwise, this might just directly turn on you. Then it might be extended on the low time frame. So you always want to have the switch levels in your back, but they need to be close. So if you are already in 3 breakouts, doesn't matter on what time frame, then you need to be careful. 3 breakouts on the 8 hour, on the 4 hour, on the 1 hour, on the 15 minute, on the 5 minute. Always, if you have that, you need a very good reason that this goes on, because as we know, after 3 it might typically pivot and then pull back. Then time rotations ahead. So if you, as discussed in the last video, if there is a major time rotation in front of you, then you don't take the trade. You need to wait for this to come in, because this always might pivot. So if you 5 minutes before a time rotation go into a trade, the next rotation might just engulf and pull back and you're immediately deep underwater. So always watch the pattern of the rotation, because typically they drop it into a large rotation, pivot, and then it turns around. Then you get your switch level and then you have your entry. Always think about both scenarios. That's absolutely critical. Then my favorite one, parabolic pressure. So you really need to have internal liquidity in the chart that unloads into also a lower time frame move. This is what gives you safe entries. I will show you what that means. That comes back to the zero pattern, for example. So if you have a coil, if you have a zero pattern that is unloading and it's underway, then you know this won't turn around here. There's no reason for it to turn around. You don't want to see the slightest reason for it to turn around. And if it's parabolic, then you just go in and it goes on. Even if you are late in the trade often, if it's parabolic, that doesn't matter. And the last one, if everything else is confirmed and you don't find any contradictions and conflicts, for me a very important question I always ask myself is this too obvious? So especially for reversal trades. So if everyone and their mother is looking for a reversal trade or for a continuation, then you don't take it, because this is in a very high amount of cases that is the trap, and you don't want to be trapped. Then you just pass the next time rotation, you wait for it if it's a trap. If not, there will be a pullback and another fake out low or something to get into that. So you really have to get into the mindset that you'll miss trades. If you jump into any confirmed trades, then you won't be profitable probably. You really need to be very selective and miss a couple of those. Only if you are extremely selective and miss trades, then you have a high win rate and will go home at the end of the week with a lot of money. So it comes down to let the market show its hand. So as long as you're not completely convinced, and that's why it's so critical what we discussed before with the mindset. You're not looking for trades, because if you're looking for trades, your mind tries to find a pattern and a reason to enter. And the longer you sit around, the more reasons you will find. So you have to fully focus on, why should I not take the trade? And if there's nothing left, and you ask yourself, if I don't take this trade, what trade would I ever take? Then is the moment to go in, but only then. So let's look at the charts. So here now an example, S&P, 19th of November. We have a potential reversal continuation long setup. You see here trend predator, previous fake out low, continuation, low hanging fruit, 1 star. It's not perfect, but it could be a nice setup. It's an inside week fake out low, so you potentially look for a rotation back up. I was really watching this yesterday. But then you see the open wicks the low and then impulsively trades into the end of the hour. And if you trade my system, you preferably trade from 3rd hour, and then you would start watching from here. So let's go through the different criteria. The first one was range too narrow, no space. So we have an open box breakout here. But you see, here is previous day high. This is very narrow. So I wouldn't do that. So space, already a red flag. Then extended on low time frame. So you see here, this is already 2 15-minute bars, and that's the third one. The third 15-minute of breakouts in a row. And the switch levels are down here. So that's the 5-minute switch, and also this was the 15-minute switch. And we are now overextended on the lower time frame, trading into the next level. There you need to be very careful, of course. And then still it's not yet done. We will watch it. So here would be the first potential entry, 10.05. But as we said, that doesn't make sense. Then we wait one more. We get a 5-minute fake out low. This could be even a nice continuation entry. But this is now 10.10. So this is right before the next 15-minute rotation. That's why we don't consider any entry, and we are also still below this level. Then let's go further. That's the next time rotation. 15-minute rotation pierces the level and pulls back. And there you already see why you shouldn't do that. So let's see what's going on. From there, it's just pulling back down and then loses the level. So this is what you would expect. 3 5-minute bars, 15-minute bars up, hits a level, 15-minute time rotation. And then even if you have a setup, inside week, whatever, you would not go long here. And what's also important here is not enough parabolic pressure. Let's check that. Parabolic pressure for me is always you watch for peak formation high, peak formation low, range expansion, coils, range expansion. So here we have London working a low, trapping some lows, then it puts in a high and then pulls back again. So this is our range, and we go for a one full range expansion of this peak formation low, peak formation high. So your parabolic pressure is this here. This is the parabolic move, and here the fuel of the parabolic move is gone. So why would it go further? It can, but then you need a parabolic situation on the higher time frame. One last reason, it was pretty obvious. So it was hitting support, it was bouncing from previous week's low, it's an inside week low. Probably many people are looking at that, and if they see this strong move here, it's a pretty obvious trade. Doesn't mean it can't work, but you need to be careful. So this is one example that I watched yesterday and then actively decided against it exactly for these reasons here. One more example, gold yesterday. Also very nice situation, all time frames bullish. Everyone bullish on gold. So there you already know everyone thinks it's going to the moon. It did its pullback retest of the monthly level. And now we are going to the moon. We just look for breakouts. But also this already starts with it's pretty obvious, right? Then on the other hand, you see here already on Trend Predator, also if you look at the charts, of course, you have an 8-hour 3 longs and then 4-hour 3 longs. So it's just working its way up. There's no real parabolic situation. It's just making higher highs and lows. So there's no parabolic fuels in this chart. So also there, you need to be careful. Okay, let's see open box, how it trades. Open box, fake out high. Then you get a fake out low. So this potentially could be good if you're going further. So let's look at the next candle. It's breaking out. Watch the clock, 10:10. Same situation as S&P. 10:10 is not an entry because we are right before the next time rotation. Next time rotation is 10:15. So if you get a breakout with 10:15 and then a continuation, the next candle, this could be nice. But a breakout at 10:10, then you might say, okay, we need to watch what 10:15 is doing. 10:15, fake out high. So it broke out, but you would not go into this breakout. So you really want to see what this candle does here. And the 15 then is a very nice pivot in the chart. So 3 8 hours of long. Then also you see here it's not overextended on the 5-minute, but it's overextended on the 15-minute. So on the 15-minute, this was just the third breakout candle also overextended. Time rotation here, and then it just turns around and pulls down. Also you see the 5-minute switch candle was down here, and also the 15. So those switch candles were already very far back. It was obvious it was pushing into the 15-minute rotation, and it's overextended on the lower time frame, and it's actually a very nice reversal pattern. So we will look at that from this perspective right now, because this is what I was looking at, and I was also taking this trade. It was an 8 hours of longs of in daily breakout. That's a template. So 3 pushes outside a breakout across the 4-hour and the 8-hour, and then you would check especially time rotations. Very nice pivot, then an open box fake out high, but you still wouldn't take the trade here because you would trade into the 8-hour level, so you wait for the 8-hour to be lost. Here 25 time rotation, you would need to wait for that, but then you get a retest of the 8-hour at 30 and 35. There's another fake out high continuation, so that is your entry. And if you from here also would look at the 15-minute, then you also see that you already, we can do this for a moment, you already see that you have a 15-minute switch candle. So you have a 15-minute switch candle in your back, you have a 5-minute switch candle in your back, both very fresh, setup confirmed, lower time frame continuation trap here. That's your trade. So from there it just melted, and this was a perfect trade. Most people going long, obvious, trapped at the high, all the criteria met, then you have your trade. Takeaways. So we discussed not taking trades might be one of the most important skills for a trader. Everyone is looking for trades, and of course you need to learn first what to look for, but then very quickly you have to find reasons for not take the setups and be selective. So the first task is to develop the awareness to stop doing stupid stuff. So trading without a setup to jump into trades, or to chase trades with FOMO mindset. That's the very first thing. Then, if you have a setup and you have a playbook and you know exactly what to look for, then you need to fine-tune your setups and develop the skill to really build selectivity around this specific setup. Trade it every day, rinse and repeat, and build the intuition when this works out and when not. Really look for when not to take your trades. That's the major skill you need to build. And this skill separates the many from the few. If you're interested in the tools I've been showing you, Trend Predator, follow this link. There's a free trial available.